Welcome to This Week in Intelligent Investing, where we examine timely and timeless investing topics to help you become a better investor. Enjoy authentic, unscripted discussion featuring Phil Ordway, Elliot Turner, and other thought-leading investors, brought to you by MOI Global. And now, here's your host, John Mihaljevic.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. It's been a crazy week in the markets, and I think we've thrown out our playbook in terms of having a couple of different topics to discuss. I think the focus will be what's happening in the markets right now, but also just some broader implications, some more evergreen insights, hopefully. So we're not necessarily just focused on what's going on in the markets, but we're using that as impetus to discuss a range of topics that relate to that. So Elliot, great to have you and Phil here. I want to start with you, Elliot. So just lay it out for us and we'll take it from there.
Great. Thanks, John. So, we've obviously been asked by friends and family about what's going on. And I've been asked by some other, colleagues, first off, why even pay attention? And I want to answer that question directly because I think it's an important one. I think it's so important to pay attention to extreme outlier situations in markets because you can learn a lot about true first principles from these events. And there's a lot that I come to think about. And it's scary, the questions I'm being asked by friends and family, because I think it really lacks a good context. And one of the things that's really clouding objectivity as people approach a situation is how right now this Robinhood versus the hedge fund situation has been cloaked in populism. And there couldn't be anything farther from the truth. And it's scary because I do think, obviously there are a couple hedge funds on the ropes right now. The situation's pretty tenuous for those specific hedge funds. But outside of that universe, there are some hedge funds doing just fine, some probably cleaning it up right now, and they're going to sit back quietly. And with GameStop having a market cap as we speak, upwards of or flirting with $20 billion, it had been higher earlier, there's going to be that much amount of money lost in this situation. GameStop's going back to where it started. There is no one sitting on the other side of this curve willing to buy. Short squeezes are as old as time. As old as markets have existed, there have been short squeezes. The Vanderbilt era featured several prominent short squeezes. Cornelius Vanderbilt himself, the Commodore, built his reputation in some respects on abstracting the stock market and understanding how you could position and corner people and use it strategically to take control of key assets. And it was a very different game back then. Typically stocks traded at par value, much like bonds today. So, 100 was what a stock was worth and its yield was what you got. And he realized there was far more to it than that. But even more recently, we've had short squeezes. There was a dry ships short squeeze a couple years ago that saw the stock go up 1,500% in a very, very rapid amount of time. The one hallmark of all of these is on the other side, it goes exactly back to where it started. Why? Because who in their right mind wants to buy GameStop once it cracks at a $15 billion valuation or at a $10 billion valuation or $5 or whatever? Because the thing is literally, not worth very much. I don't want to say worthless. It's got some value. And it probably had more value than where it started this run at because there's reflexivity involved. The company could raise money and get itself in a little better shape. But one of the things that's really frustrating is you see these billionaires like Chamath piling on to the populist narrative. And it really disturbs me because, it's retail people who are going to lose, who are going to be the big losers here holding the bag when it all ends. All these people on Robinhood are saying buy and buy more and buy more. They're just ratcheting up their exposure. And there's going to be absolutely no one out there that's left to hold the bag, that's left to take their shares and let them actually cash out for a profit. Effectively, what they're playing is the greater fool game or hot potato, right? They're passing around the hot potato. And, where it stops, no one knows, but the losses are going to be massive. And then, I want to talk about another thing because, like, obviously there's this angle, but there's also the angle of what the hell was Melvin Capital doing? Like, why were they this vulnerable? What sort of positioning do they have on? Melvin Capital is a long short strategy. They deploy somewhere between 200 to 400% gross exposure, meaning for every dollar they actually have in investments, they have, call it $3 to $5 of actual exposure in the market. And they should theoretically run with a net that's somewhere from like 20 to 80%, depending on market environments. Probably 80% is too high, maybe 50%. I'm just talking generally about how the typical long short, like highly leveraged strategy works. And what Melvin was doing, right, in a lot of ways, like when they short a stock, their goal is not necessarily to have the stock they're short go down. Their goal is to find something they can buy that'll go up more than whatever they're shorting goes up. So in a sense, right, in this world, there are two kinds of shorts. One is a short that's for alpha, where you actually want to make money on the short side of things. The other is a short, which is what I'd call a funding short, where you're merely trying to get more leverage on the long side of your book. And what you're trying to do is you're trying to minimize the amount of market risk you have, which we also, in industry parlance call beta risk. And, in actuality, it's presented as this, we don't take much market risk strategy. So, we're better than those long only guys who are taking market risk. And you might have to, realize a drawdown if the economy goes lower, et cetera. But what they're truly doing, anytime you get rid of a risk, you're opening up another risk. And they then are opening up what's called basis risk. And basis risk is the relationship between their long and shorts. And that relationship, while they might think by and large they can make more money on the long side than they'd lose on their shorts going up, sometimes really crazy things can happen. And, what really irks me here is you can't truly be stuck in GameStop. At a certain point, this thing's done enough volume for like 5 days running. It's traded its entire shares outstanding anywhere from like 5 to 8 times over. So even if the short interest is 150%, there's been plenty of shares to cover. At a certain point, they went from, having a really bad position to making a choice to try to see it through and not, exit their position, lick their wounds and move on to the next thing. And that's just terrible risk management. And you know what? There's no need to cloak this in populism. A couple of hedge funds made really bad trades, and that's what it is at the end of the day. But it's been really frustrating seeing a lot of these narratives take hold that have nothing to do with what's actually happening here. And I hope, everyone, like, if you want one real lesson out of this, the fact of the matter is the stock market's been a phenomenal wealth builder for retail investors. But the key has been spend less than you earn and save money, invest patiently and get rich slow. And there are like hundreds of great stories about that. And I hope that's where everyone ends up focusing on. But I, fear that's not the case along the way. So with that, I'll end my rant, pass it on to Phil, and look forward to discussing this more.
Yeah, I mean, I was hoping, or I was reluctant to even address this because, I mean, my first reaction to all this has mostly been who cares and kind of boredom at the surface, because it's just so discouraging to me to watch it unfold. I mean, you're exactly right, though, Elliot. I mean, there are important forces at play here that need to be understood, and there's a lot of lessons to be learned. But, just the amount of absolute nonsense that's being bandied around. I mean, I was just reading some thread by a very prominent allocator who's ranting and raving about a whole bunch of stuff. He doesn't even understand the most basic mechanics of how short selling even works. I mean, it's stunning. The former CEO of NASDAQ was on TV last night, and my wife and kids were watching it, and he didn't understand how short selling works. I mean, it's unbelievable how many complete and utter novice amateurs are risking real dollars in this thing, and how many completely clueless people are out there just blowing opinions into the wind and feeling completely, correct and righteous, and having all of these very deep opinions that they're not qualified to hold. So, I mean, this is, I mean, on the one level, I do find it fascinating because there's about 19 of the major psychology of human misjudgment principles at play all at once here. And that is, of course, how you get such crazy things all happening at once, is you have multiple factors all acting in the same direction at the same time. I mean, again, short squeezes are certainly not new. Like you said, nothing interests me there. It's just a feature. It's not necessarily a bug. It just happens. Markets are prone to doing crazy things in both directions all the time. That's certainly not new. I mean, I guess what is new, at least to a little bit of an extent, and I should know more market history about what the zeitgeist was at the time and in prior periods of mania and speculation in areas where there were big problems like this that developed was there this sense of just deep-seated anger and nihilism. You described it as a sense of populism, which is also true. And I have a feeling there probably is. I mean, that, the anger of the crowds and feeling wronged and that they're doing something that's avenging that wrong, that can't be new. So I can't point to a specific example, but I feel like there have to be at least some parallels out there. I do find it, like you said, really, really discouraging to watch people that should absolutely know better go on TV, go on Twitter or whatever, and just egg it on. Like this is some sort of, WWE fake wrestling match. I mean, it's really just disgusting. I mean, that's probably not to sound like, the archetype of the old man shouting into the wind that I am vulnerable to from time to time, but it's just so wrong to see the casinofication of the markets played out like this, because look, it's not about a moral preaching, speculation and gambling are wrong. I mean, look, people are entitled to do whatever they want to do. It may or may not be a good idea. It usually doesn't end very well. But I was literally telling a family member of mine who was asking me about all this on text, I'm like, look, if you really have the gambling itch, go gamble in a game that you at least understand, where what the casino's take rate is, and literally go to Vegas. Don't do this, because the casinofication of this is just not going to end well. And I mean, we've been critical before of how Robinhood has used, scratch off lottery tickets as their basic operating model, and all the confetti that they blow and all the nonsense and this is, that coming home to roost. So I guess we really shouldn't be surprised, but I do find it really disturbing to watch the casinofication of the capital markets just get worse and worse. And it's very ironic, because to the extent there's, a populist narrative of this and the little guy and the underdog and all that, they're their own worst enemy in this. And everything they're doing is making the problem worse, not better. Not even just in the short run, but especially over the medium term and the long run. I mean, this is the exact opposite of what you'd want to see happen if you really cared about that sort of thing. So I don't know if I can find any silver linings yet. I mean, I don't have any super specific policy directives that could be implemented overnight that would fix this sort of thing. I mean, it's sort of like all forms of other, self-destructive behavior, where unfortunately sometimes you just sort of have to let it play out. And I'm not sure I see some better answer than that right now. What about you, John?
Yeah, I mean, it's a really tough to weigh in here. I mean, first of all, I think, speaking for myself, I have no interest one way or the other in any of these, GME or AMC. And I think the same goes for you guys as well. So we're just kind of opining on this situation. And once GME, GameStop got above any reasonable fair value in terms of its stock price, you were in danger territory. It was just a matter of how it's going to play out, but you knew that it was going to play out badly. Maybe at $4, you can make an intrinsic value case, maybe even at $10. But once you're at $200 to $400, it's just you don't know how it's gonna blow up, but you know that there's gonna be some really bad news. I think, where this populist angle gets some wind under its sails is just how this seems to be unraveling. Because I think one way that this could have basically ended was for the shorts to cover and for the longs to sell at these prices, so that basically the short interest goes down to zero and the shorts have to cover at a huge loss. What seems to have actually happened, if you look at the short interest, is it hasn't gone down. It may even have gone up. So that would suggest that the shorts don't plan on taking a loss here. They're actually potentially reloading to make even more money from this. And then when you have brokerage firms like Robinhood not actually allowing people to buy, but only to sell, that's where I can see kind of this narrative coming in, and it's going to be a very strong narrative. Now, I don't agree with this narrative because everybody who's in the market is just trying to make money, not make some point, or at least that's what I would hope they're trying to do. The market has never been kind of a moral place, if you will. There are rules of engagement, but ultimately people invest to make money. To your point, Phil, this casinofication of the stock market, it's very, very unfortunate. It's a sign of our times. It's a sign of, just how widespread social media has become, and but it's also a sign of just the fabric of society just isn't what it used to be when you have even Nancy Pelosi buying call options on specific stocks, where she's going to be involved in legislation that's going to affect those companies. How's that right? So I feel like, unfortunately, we're way past the point of any kind of imputing any kind of morality into markets. So I think the solution really is education. That's really the only solution, let's say, for the quote unquote small investor. Be educated. People gave Robinhood their money without really knowing or caring that Robinhood was selling their order flow to hedge funds. And that's where you gotta just educate yourself on how these things work and say, I'm not gonna have an account there because they don't have my best interests at heart. You take, let's say, an Interactive Brokers, they don't do that. So basically, I feel like education is the answer here. Not that I have no hopes that that's actually going to happen, but I think, everybody needs to be a little bit more introspective and ask themselves what they could have done differently. So back to you guys.
Yeah, that's a good point, John, about education. I'd love to see that, because I think whether it's this example or just basic financial literacy, it's been on the decline for a long time, and it shows. And not to say that the past was ever perfect. The nostalgia for back in the good old days when men were men and that sort of stuff, that doesn't really have a place in this argument. I don't think that's often just lazy thinking, but I do agree with a lot of your sentiments. And I think as a prescription, as an answer, that might be the only possible one, is to just try to teach foundational skills and basic numeracy about how this sort of thing works, because we just leave so many people ill prepared to tackle these sorts of things. And then you give them really powerful tools. Why on earth average investors, small investors, whatever term you want to use, have access to options on a platform like this is just kind of bizarre, right? I mean, and if they're going to have access to those sort of tools, you can't drive a car without a driver's license, but you can do this. It just doesn't really make sense. So I think you're right that education is probably the one and only answer. It's just easier said than done.
Yeah, I think that's a it's the end all be all of this. Like, people need to get educated. I think it's, on the one hand, great that so many more average people have taken an interest in the stock market. At a foundational level, when you start having success in the stock market, it encourages you to think about the opportunity cost of a dollar you're spending. And so it incentivizes saving more, especially in the early stages of getting that interest. But one of the problems is that when you start having a certain kind of success that's, I'd call it fleeting and, spectacular, like some of these people are experiencing in GameStop, and in general, some people are experiencing since having just gotten involved in the stock market in March. What great timing, right? You've never experienced anything harsh because you joined at the worst of the worst in recent times. The stock market's humbling if you don't get things right. If you don't position yourself right. I mean, just look. Melvin's one of the smartest hedge funds out there. They were printing money for I think 7 years now. Phenomenal track record, the envy of the industry in a lot of respects. No matter how smart you are, if you don't pay attention to certain core principles, the market's going to humble you. And it's better to learn from other people's mistakes than your own. But the fact that a lot of these people are out there on Reddit egging it on, and you have the Chamaths of the world egging it on. I mean, it's kind of the opposite. It's like you should be like, take your victory, pocket it, and look for something smart to do with it. Don't encourage people to buy more GameStop here. It's not a joke. Someone's going to buy GameStop here and end up selling it like $10 a share. And, the consequences for people's lives when they lose that kind of money and don't understand, add options as fuel to the fire. It's really scary. And I got to share, the reason why I'm so fired up and passionate about this is my family. I mean, my parents were, my mom's an immigrant from Poland, was a political refugee. My dad's the child of a Holocaust survivor who never got his fur business going. They came from nothing to middle class. And, we, I think, felt a certain hubris during the .com days because they, my parents were attuned to the stock market earlier than other people and rode the bull. And the other side of it was not fun to experience. And it was humbling. And it really taught me a lot about life and not just the stock market. And so I felt the other side of it. And so I feel even more fired up, trying to share, trying to help the people I know and love today that I've, heard these questions about what should I do? Should I get involved in GameStop and this mystique about it? It hurts me in my gut. So, if I sound a little more fired up than usual, that's where it's coming from, because I've seen what happens if you get over your skis in your approach to the market. And I think that's the most dangerous thing. It's the worst lesson. It really terrifies me. And, there's a lot of good. I love these stories about the janitor that saved money their whole life and passes with, an $8 million portfolio that no one in their family knew they even had. Because that's the real beauty of the stock market. It is democratic in that sense. It is like a populist dream in a lot of ways. And there are all these myths being passed around how hedge funds manipulate this and that. At the end of the day, right, Ben Graham's right. If you're fundamentally right about something, the market, short run voting machine, long run weighing machine. And you could look at these people talking about shorts on a morality sense. I got responses about how Elon Musk, he has every right to be angry about shorts because they tried to take down his business. They did not try to take down his business. They expressed a view and got smoked for it. And you look at how Reed Hastings handled that very same situation about, it's almost a decade ago when shorts came into his hedge fund. He's like, when shorts came into Netflix stock, they didn't imperil his business. They didn't put his business at risk. He wrote them an honest letter. I think you're wrong, and this is why. And he buried his head and he executed, and he's phenomenally successful now because of it. Deliver, be a good operator when you're the CEO of a company. Stop worrying about this stuff. It's all junk. Sorry, I'm ranting again.
No, but look, that's what I mean about the ignorance and the innumeracy is you get these arguments like, oh, they're trying to ruin this company. And it's like, GameStop just is what it is. And And I've yet to ever see a company forced into bankruptcy because the market quotation on its equity declined. I mean, it's just nonsense to make that kind of argument, but that's the populist garbage that's being thrown around right now. And so on a somewhat different note, but related, I wanted to make one other point, which I just reiterated in my annual letter, which is this concept of securities first versus business first analysis. And that can be useful as a way of taking the temperature of the market, because obviously as you sit here and you look at a macro perspective and say what's going on in the market, you just really get to the point where the plural of anecdote becomes data, and we all know that's wrong. I mean, you look at all these one-off little things and it can only tell you so much. But I think it does stand out to me, at least right now, that this is one of the most securities first markets I've seen in at least the last 10 or 15 years, and probably going back further than that. And I should back up a step. By securities first, I mean that people are doing analysis and making decisions on the basis of what's happening with the security. So will the stock price go up or down? Is the stock price interesting? Is the bond or the option or whatever the security itself is that something that I want to do, participate in, what's happening to the price level, versus business first investing, which is actually considering the business as an enterprise first, evaluating that, trying to understand that, and then looking only secondarily at the price of whatever security you might be interested as a way to execute an investment that you have some sort of opinion on. And so this gets back to something we were talking about a week or two ago. We got a question that came in online from Brandon O'Leary, if I have the name right, where he asked if I wasn't confusing or mixing metaphors about first and second level thinking, Howard Marks' framework, and the tie to the Keynesian beauty contest. And I had sort of referred to this overabundance of first level thinking and a tie to a Keynesian beauty contest sort of thing. And I guess to clarify, he's right. There was a memo in 2015 where, in a narrow sense, Marx was tying a Keynesian beauty contest whereby you're trying to judge not who the best looking person is in the beauty contest, but who the other judges are going to pick as the best looking person. And so it's kind of the second derivative effect. And he was tying that back to second level thinking. My point, and actually he goes on then to kind of make the point I was trying to make and just wasn't articulate enough to do a couple of weeks ago, was that that's really just about short-term trading, right? And so a short-term trader who's got any level of staying power and skill is, of course, going to do it at a second level as opposed to a first level, right? And that's clearly what's happening now. And the problem, of course, is it gets down into second and third and fourth and fifth level thinking, where it's just a circular reference that never ends because you're just trying to outguess the next person, right? You don't care what the business is worth. You don't care about any sort of measure of value and capital allocation in a functioning, society where money finds a decent purpose and is a productive, has a productive purpose. It's really just about outguessing the guy next to you. So that was the point I was trying to make back then. So we get into some semantics here. So yes, Brandon's correct that, Howard Marks had a little bit different point that he was trying to make with the Keynesian beauty contest and an analogy, and I kind of mixed metaphors there. So he's right about that. But I think the point still stands that it really just pertains to this very securities first kind of market, a very short-term trading kind of market where nobody cares about what's happening. It's all just about what's going to make prices go up and who's going to find this price attractive. And again, this is why people are just looking around and saying, well, if something has a short interest, I'm going to buy it because that's going to be the next trigger to make the stock go up. A lot of these people probably couldn't even tell you what the business does. And so, I think it's an unfortunate and dangerous kind of outcome, but that's the world we're in right now.
Yeah, I think one interesting thing that's happening relatedly is because of this environment being focused on securities. I mean, I've somewhat lamented that in the wake of the great financial crisis, the market had, correlations had been much tighter across all sectors and within sectors. And so there really wasn't much, like every stock, like the most apt way to explain why it moved on a given day or on a given month or even the year was what the market did. And so, COVID actually really was the first catalyst, but we've really seen a whole lot of dispersion. And I think that's interesting and helpful because, obviously as a stock picker, where I'm focused on, not just owning the S&P, I'm focused on finding the best opportunities. I mean, great. It's awesome for us because it creates a really big opportunity set. It's the kind of opportunity set that, we've obviously had chances along the way and have done fine with it. But there's a whole lot more chance when you start having individual stocks move with a mind of their own. Obviously, the flip side of that is there is a, pretty strong increase in speculative behavior. And so, like you pointed out, Phil, like people that are seeking price as opposed to, understanding a business, that's, there's always a degree of that in the market, but there's a lot of that right now, and it's not healthy and it's not constructive. I have gone back and I've been reading this week Capital Account, which is what I think, it's really hard to find a copy of it. But it's one of the best investing books I've read. Capital Returns covers a lot of the themes, but they make an interesting point, the guys at Marathon, which is that, and I think we've seen it play out over the last decade. One of the greatest inducements to invest are high equity values. If equity values are not high, companies are often incentivized to repurchase their own shares or do other things that are not investment related, like dividend out their cash. But when stock prices are high, you have to invest to try to justify those high prices. And, you can't just buy another competitor or whatever. You have to invest in your own business. And so, like, when you think, not from a specific level, but a broader level in our economy, we've lacked like actual capital investment growth for a long, long time. And so, when you think about where things could get somewhat reflexive is we finally have this like real inducement to invest. And that has very good effects, good ripple effects for the economy, good ripple effects for jobs and all that sort of stuff. So that's one interesting consequence of what's happening. But, that often like what happens is it gets stretched way too far and becomes quite messy and scary. So like the Marathon guys were warning about too much froth in the telecom companies as early as 1994. And they then invested like cumulatively, I think they said something like 5x their entire invested capital from that they had in 1994 over the next 5 years. And, that's how it goes from something that has perhaps a sound basis to a bubble and things get absolutely crazy. So, where I'm going with this, I don't know how to like synthesize my thoughts, but it's something I've been thinking about a lot lately.
Yeah, I don't know if I can kind of tie into that specifically, but I think, basically the market has kind of become less of a free market over time in a lot of respects. I feel like just because of what the Fed has done every time we've had a market downturn, what you're seeing on the, let's say, long-term bond side in the long-term bond market. I mean, some segments of this market are just really twisted at the moment, and so a lot of investors haven't really learned that the market has downside. That markets are cyclical, just like the economy is cyclical, and so a lot of lessons have kind of not been learned just because of how the market has behaved, because it's received a lot of stimulation from the Fed, and then I feel like the regulators are really asleep at the switch. When something happens like what we're seeing this week, you suddenly have Ted Cruz and AOC tweeting how this is not right, but ultimately they're not doing anything that makes sense to actually help people going forward. Why wasn't there any regulation around selling order flow to hedge funds? That's something that could have been taken on, but there wasn't some huge public outcry about it, so it was kind of a waste of time for politicians because they wouldn't score any points doing something that's so invisible, even though it would be hugely useful. And Phil, you talked about how Robinhood allows people to buy options. Not only do they allow it, as far as I understand it,
they
the app
encourage
design
it.
actually pushes them into options. Like that's your
and they jigger with the disclosure so that when you buy something, depending on which side of the trade you're on, it shows like maximum amount you could gain, but then it doesn't show how much you could lose. It's like how much the security would have to move to like get back to break even or something. It's the most disingenuous, disgusting disclosure you've ever seen in your life.
Yeah, and I understand that, the regulators can't necessarily be in step always with the newest innovations, but they gotta start closing that gap and, not waiting for things like this week to suddenly jump on some populist bandwagon to score political points. If you had financial regulators that actually are doing their job, they'd be looking at apps, financial trading, stock trading apps like Robinhood in a systematic way, and they'd be asking, what is actually good for the customer? What do we need to do about this? But no one cares. And, I guess after this week and once this thing kind of quiets down, I'm really not expecting anything constructive to happen.
Oh, I agree. And I think a big part of that stems with the fact that if you were to give every member of Congress just a basic financial literacy test, let alone about something, relatively in the weeds about selling order flow, they would fail miserably. I'd bet a lot of money on that. So, the change isn't going to start with them. It's going to have to start somewhere else and be, spoon-fed to Congress in a way that they can digest and deal with it if there's ever going to be any regulatory change from the top down. And frankly, I mean, look, I don't even know if I were the benevolent dictator of that world, what would I do and how would I go about doing it? I think it's a really thorny and difficult question, right? I mean, you don't want to over constrain people. And like I said at the beginning, I think it's really hard when people have the urge to speculate or gamble. I mean, that's an ancient problem, right? And it's hard to get out of the way of people that want to do that. I mean, so look, it's ironic that this is happening at the same time that we're legalizing sports betting. That was always in the shadows for so long, and now it's largely come out of the shadows, at least in the U.S., catching up with other parts of the world. And I think this had roots, going back to last year when a lot of the sports, didn't exist for a period of a few weeks or a few months, but the securities markets, the capital markets were still open and commissions went to zero, and Robinhood and others came out, and that form of gambling kind of took off. The seed was planted, and this is the fruit that it's bearing, and it's frustrating to watch. But I don't have a single fail-proof answer to fix it.
Yeah, I think Robinhood and regulators in some ways are in a lose-lose position because this is about populism, right? This is about giving power to the many people versus the few billionaires. These are the terms that it's all cloaked in right now. And so, if Robinhood stops this behavior, it's like, well, whose side are they on? If they just turn a blind eye and, everyone knows there's going to be big losses on the other side, they're going to be blamed anyway, and they made their own bed on that front. And so, not that I have sympathy, I just have no solutions. Like, I don't really know what the answer is. I think it gets back to what John said earlier. It really does come down to education. And one of the things I really like Cash App kind of cloned Robinhood and did their own approach to it, but they gave this really, if I could use the word cute little book describing the stock market and how to invest in the stock market, and encouraged everyone to read this 30-page. It was kind of like a half illustrated, half text book, which is really, a fair perspective on what it means to invest in the market and what markets are like. They didn't add in options. They didn't do any of this junk. And they just encourage people to maybe set an auto buy program for once a week to buy a few shares of your favorite stock sort of thing. And they offered fractional shares, which, some people don't like, some people do like, but at least they approached it from a sense of let's tie education directly into this and not, open ourselves to some of the really bad stuff that could happen. And yeah, I do think it has something to do with sports having closed, because Dave Portnoy helped popularize this whole like everyone should be investing. And I do, again, there's a good and bad to it. I do think people should be thinking about the stock market, how they can invest, how it could help them build wealth. But it's not a game. It's not like sports betting. I'm an investor in sports betting. I mean, that's an interesting space in its own right. But like, that behavior should not be brought to the stock market. And if it is, put a very small portion of your total wealth there, and make sure you're in securities where you could have a very clear sense of what your downside is, and you can't, zero is your legitimate floor, because it's dangerous if it's not approached the right way. And it's I keep saying it, but it's scary and sad to see.
Yeah, it is. And like I said earlier, I mean, I just keep coming back to the thought that, you can't predict when, you can't predict how. It's just a fool's errand to even try the psychology rules, but the math still matters. And it's just like a forest fire or a virus or anything else like that, because eventually it just kind of burns itself out. And so there's a lot of pain and destruction and nonsense along the way. And it's unfortunate, but I don't, just like you could make all sorts of arguments about the best way to manage a forest fire, and to prevent it, or to prevent the next one, or to fight it once it's started. It's they're a feature of the ecosystem, and I don't think you can prevent them any more than you can prevent the wind from blowing. So at some point, you just kind of have to deal with it. And look, that's not to say that I don't support. I definitely support guardrails and regulation and common sense stuff. But I'm just, thinking out loud in terms of broad brush stuff you could do to prevent, harmful speculation. I think it's just too hard. I don't know that you can do it.
Right. It's human nature at the end of the day.
Right.
It's always been with us since the South Sea bubble onwards. I think every investor just needs to understand that, he or she is their own best friend. And first and foremost, it's about survival in the market, and no one's going to pay your bills if you lose all your money because you wanted to be part of some herd and do whatever the herd says. You're going to be on your own, to pick up the pieces when it's all said and done. So you got to make sure that you know what you're doing, and it's about survival. I do agree that, investing in the stock market per se can be a great thing, because unlike in a casino where you are going to lose the more you bet, stocks historically go up at a pretty good rate, above inflation. And so, if you just let that long-term compounding play out and have the attitude of getting rich slow versus getting rich quick, you are probably going to do fine. And, understanding that you're buying pieces of actual real life businesses and analyzing stocks in that way. I mean, we're back to the basics here, right? And it's pretty simple. I mean, people should just go back and read Warren Buffett's letters and just study this. This is not a casino. This is not something you do in lieu of sports betting or going to Vegas. This is saving money for your retirement or for whatever other financial goals you have. But it's serious stuff. And so I think people just need to, find their fun elsewhere. You walk into a casino, you're doing blackjack, but you're not betting your life savings. You're betting $20, $50, $100, here, people are actually betting the money that they cannot afford to lose. And that's a big problem.
And by the way, I think there is an angle to have fun along the way in investing. And it was taught to us by Phil Fisher, right? You don't have to go out there and find the smartest thing to buy. You could stick to what you know, to products you really like, and use a framework that at least tries to triangulate value, at least think about what something's worth and whether it's reasonably fair and reasonably, likely to at least not get you smoked over a few years if you're a retail investor who's just approaching the market from a position of, not knowing the toolkit of a professional. So there are approaches you could take that I think, it's quite fun. There are things like, give a couple shares of Disney to a kid. Not saying that everyone should go do that, not saying that as an endorsement of Disney, the stock, but it's something that's fun where like the harm in it, what's the worst that could happen if you buy 2 shares for your kid? You'll lose $300, right? Something like that. Probably, $350 or whatever. But it's fun and it shows that it could be personal. It could be related to what you enjoy and take pride in. It doesn't have to be like this super serious place where everything's like, not supposed to be treated with any lightheartedness. So, there's an angle there. And I think, a lot of people would do well reading like Phil Fisher, Peter Lynch, and understanding how accessible the stock market could be if you approach it in the right way.
Yeah, I totally agree. I just keep coming back to, I think John was getting to this. I mean, the quote, the soundbite that keeps jumping into my head is from Ben Graham, and it's that the investor's chief problem or even his own worst enemy is likely to be himself. And so I'm totally with you that, I obviously think it's fascinating, endlessly fascinating. And I think a lot of people feel the same, but, it just is hard for a lot of people, and certainly myself included, to get out of my own way sometimes. And so if you don't devote some serious effort and attention to it, what are you even trying to do? Because like you said, John, I mean, you can go bet on a sports game or go play blackjack at a casino. And it's most people, I mean, look, addiction is a real problem, but most people aren't going to do that with the kinds of money that's going to involve their house or their livelihood or whatever. I mean, they've learned to kind of compartmentalize that. And that's why I think the casinofication of markets is so dangerous, was because there's real money at risk here for people. And we already have a retirement crisis, at least in the US, for a huge chunk of the population. And gambling with corporate securities is not a way to solve that. That is almost guaranteed to make it far worse. So I'm pretty wary of anything that, gets out of a savings mentality into a trading or speculation mentality. And, the irony of this whole thing being so deep is that we've gotten to this point where, we have free trading without a lot of online commissions, but you still certainly have psychological commissions, and you definitely still have taxes. And, the mistakes are still every bit as painful as they ever were. And at the same time, you have, unlimited ability basically to capture all of that in a much friendlier long-term way with index funds, which have, gone from nothing in prior decades and generations to now a very significant part of the market. And yet here we are going back into some, retrograde behavior on the day trading side of things. So it's just really bizarre. I mean, bizarre is really the word that I keep coming back to on this whole thing. It's just bizarre.
And I think there's one really simple rule that everyone could set for themselves that I think would basically solve a lot of this. And that would be something around the turnover that you allow for yourself in your portfolio. I think this huge turnover, the day trading, the short-term trading, that is such a huge part of this problem. If you want to just kind of really lower your chance of losing a ton of money, just say, whatever I decide to buy, I'm not even going to think about selling for at least a couple of years. And look out and try to buy, quality businesses, as Elliot said, companies where you know the product, you know what you're buying, and then just sit on it. That I think that would go a long way for a big segment of the market.
No, it would go a very long way, but it requires patience and discipline, and that's not fun. It's not entertainment, right? I mean, that's the problem, right? Is we're using this as an outlet for entertainment and tawdry, reality television style entertainment. And it's, what you just described is, of course, correct and the right way to go about it. And it just doesn't fit with the zeitgeist of just, blatant raw entertainment. And that's apparently what combined with a dose of anger and populism and nihilism thrown in on top for this toxic brew, that seems to be what people are more interested in.
But I do think it's such a good point because, like, when you think about Robinhood, to me, their fatal flaw is they took away all friction to actually making decisions in the market. If it costs you $10, to get in and $10 to get out, there's $20 of friction that you had to at least think, if I'm going to put money at risk, I have to make that back first before I even make $1. So, like, maybe I should think twice about this. And going to zero commissions means you could just throw money around at your whims. And so, that getting rid of that friction is not necessarily a good thing. There's a Munger quote about like the notion that like liquidity enhances capital markets is largely twaddle. And I think what he was really referencing was that, at a certain point, liquidity is helpful, but there are diminishing returns. And then you could cross a certain line where it's actually the opposite. And personally, I'll tell you my secret is that I've used a soft target of 20% annualized turnover. And I've like somewhat changed the language I've used around it. I once called it an actual target, more like a ceiling than a target. Not that I'd purposely transact more to try to reach it, but that, once I hit 20% on a year, I'm like, let's stop making any moves and, think about it next year. But I now call it a soft target. And to me, it means two things, 20% turnover. If I have an average position size of about 5%, it means I'm going to hold my positions on average for 5 years with 20% turnover. So I'm making decisions on a time frame that's consistent with my turnover target, right? And I'm thinking about like, I'm going to buy this thing and I'm not going to touch it for 5 years. And that means I have a hurdle to actually get myself to action. And the second thing is it really means I only need 5 ideas per year. I don't need 5 ideas a day. I don't need to throw around like, ideas as if they're stuck in the wind. I have to do my work. And each year I have to make about 5, let's call it 10 decisions because I typically have to sell something to buy something, but no more than 10 decisions. And decision fatigue is real. So like, the fewer decisions, the better off you are. And it avoids this spiral where bad decisions beget bad decisions. If you make too many bad decisions, one after another, you could risk, in poker terms, going on tilt and making really bad ones. So, creating friction and having a burden for action, I think is really, really helpful. And I think it's one of the best things that retail investors could do out there.
Yeah, I agree. And I think, I've thought a lot about the role that zero commissions play in this whole thing. And of course, you're right that it's removed a friction and it's removed a reason for people to pause and think twice. But, even if you look back in, 50, 100 years ago, longer, when commissions were really high and really painful and material and transactions were really hard to do. I mean, forget about pulling out your phone. You had to go down to a brokerage house in a city and fill out a written ticket. And then there was a huge lag to actually execute the trade. And the back office was a mess and, physical certificates and all this kind of stuff. And that never stopped speculation either. It had plenty of crazy bubbles and asinine herd psychology effects taking place in those environments. So I don't know if it's fair to pin too much of the blame on commissions heading to zero. And, as much of a critic as I am of Robinhood, it's more about the way they structure things under this faux populism nonsense. Like, we're here for the little guy, when what you're really there for is to take advantage of the little guy and set up, all sorts of psychological tricks to take advantage of the small guy. But it really isn't their fault, or it has nothing to do with them. The commissions went to zero. They're selling order flow data just like the big brokers are. And that's been a trend that's been going for decades now, right? I mean, there was no stopping retail trading commissions from going to zero, whether or not Robinhood or any other individual broker-dealer ever existed. So I do, as critical as I am of some of those bad actors. And look, by the way, I totally agree with you. I mean, obviously, if you're going to be reasonable in this regard, you need to find ways to limit yourself and to find ways to stop yourself from being your own worst enemy. But that's so far beyond the capability of the crowds in an environment like this that it's just impractical. So what could you do with some of the broker dealers to limit this kind of behavior? I mean, like I said, I think, it gets really difficult to be prescriptive and say, you should ban confetti emojis from raining down when you make a trade on an app, because, you're never going to think of every possible game that they're going to play to encourage that kind of behavior. It's just going to be a whack-a-mole kind of problem. But yeah, I think some basic common sense rules about disclosure and risk and the risk of real loss, and getting back to more of an educational mindset, like John said, as opposed to just a casino mindset, would be a big step in the right direction.
Yeah, that's totally fair. Because I mean, the flip side of what I said is, before, when commissions were like $9.99 even in and out, if you had $20, you couldn't invest. At least now in the Robinhood world, you could start with $20 and try to add that little bit, every chance you can. And so that truly does democratize investing. What I'd argue is the average person should try to put up, and it's very much what you just said, like people could build their own frictions now that there's none from commissions itself. But commissions were that kind of like hurdle to action in some cases, but you're totally right.
But if people were going to be disciplined and thoughtful enough to try to build their own frictions to short circuit their own psychological failings, we wouldn't be having this conversation.
That's very true.
We wouldn't need to go there. So that would, be great to live in that world, but I don't think that's realistic. So
one can dream.
One can dream for sure. And yeah, I mean, look, the other thing I find really ironic about this whole thing that we haven't really touched on is how the short side is being so demonized by this whole thing. And look, I think I've talked about this on here plenty, but if anyone hasn't heard it, I mean, I used to sell things short all the time at my former firm. We had a short only fund for a number of years. And, I sort of made my way shorting the financial bubble of 2006, 7, 8 when I was brand new to the industry. As it crested in 2007. That just happened to be by blind luck when I joined this industry as a full-time professional investor. And by blind luck, I was assigned to look at some of this stuff by my bosses, and I happened to figure it out with good timing. It had nothing, there wasn't much more to it than that. And so I'm well aware of the beauty and power of short selling. And by the way, the short side has been enormously valuable and powerful in uncovering all sorts of corporate malfeasance and fraud that has done real harm to the little guy, both as investors and as consumers and as citizens and taxpayers. So the short side should be commended for that. Now, does that necessarily apply to like a levered long short strategy? Not so much, but it's very bizarre that the short side is generally held out as like, the champion of the capital markets and the bad actor on one side, and is now being held out as like the institution. Like, we're going to stick it to the man by ruining these short sellers. Like, what planet do we live on? Like, short selling is so hard and so miserable and acts as a check and a balance on capital markets. If you really cared about sticking it to the man and making the markets more fair for the little guy, you should be cheering on the short sellers, not trying to ruin them.
Yep. Short selling is the scapegoat, but it's really leverage. That's, the true enemy of everyone in this situation.
Yeah,
right?
That's true. Yeah.
And leverage is getting off easy in this in a lot of ways, but I think that's really where people should be focusing their attention. Like, even the smartest people deploying leverage with incredible skill for a number of years can be run over by too much leverage.
Yep. Yeah, it has nothing to do with intelligence or skill, because it becomes, either so inherently dangerous at some mathematical limit, or the psychological factors just take over. I mean, right? I think in the money game, Adam Smith's famous book, pseudonymously written, I think one of the more fascinating subplots of that, and it's consumed Buffett for years, was why do smart people do dumb things? Right? It has nothing to do with being dumb as a person. It's that a smart person does a dumb thing. A smart person does a thing they know they shouldn't do. And when you start enabling leverage, it enables smart people, well-intentioned people, to do dumb things. And it's just crazy, but that's how the world works. I mean, there's just no denying that that's how reality exists.
Yeah, and I think when it comes to turnover, you're also not enabling turnover, but you're encouraging it. Just the way these apps work. I mean, if you're looking at an app in your portfolio every day and maybe all day or several times a day, you're just more likely to want to transact than if you're looking at your portfolio once a month when you get your monthly statement. And there have been studies around this. I think basically the less you look at your portfolio, the less you're going to transact. Makes total sense, obviously. So a lot of the struggles that we're seeing people have in the stock market, they're struggles that people are having generally with social media and with addiction to apps, to notifications, to instant gratification. That's, it's basically, I think, has just to do with the times we live in. I feel like everybody would be better off not having any apps on their phone that have anything to do with their portfolio, but actually having to log into a website and check it there, and hopefully do that only once a month or even less frequently.
Yeah, I agree. The less you get the dopamine hit, the better off you're going to be in almost all regards. I couldn't agree more.
Yeah, there's that paper from Benartzi and Thaler, Myopic Loss Aversion, and they trace the equity risk premium directly to how frequently people check their portfolios. And it's a phenomenal paper, really interesting behavioral study. And, I think there's some truth to that. Price tries to induce you into action. That's what it does. But if you just focus on the business, and check price a lot less frequently, you become a little more numb to how it's going. That said, I am guilty as charged. I check a little too often at times, though. I feel part of my job, part of my responsibility is to be aware of what's happening. But in an ideal world, I would certainly encourage myself to check less frequently.
Well, great, guys. Thanks for the discussion. I'm not sure we solved anything, but I think the perspectives are valuable, and hopefully all of our listeners found this of use as well. Thank you all. Goodbye for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.